Hello and welcome to Commodity Culture, where our goal is to make you a better investor in the commodities space. My name is Jesse Day, and before we dive in, standard disclaimer: nothing here is investment advice. Do your own due diligence. And today's episode is brought to you by MoneyMetals.com, the most trusted online bullion dealer and depository in the United States. Use Money Metals for purchasing, selling, or storing physical gold and silver. Hit the link in the description below to learn more and use coupon code JesseDay to get a $10 discount on your first purchase. And today's guest is the founder of goldstockdata.com, a guide to the pros and cons of investing in major, mid-tier, and junior mining companies. We're going to be discussing gold versus silver, which is the better investment, both the metal and the miners. It's Don Durrett. Great to have you on the show.
Thanks for having me on, Jesse.
Yeah, it's a pleasure to have you on. I interviewed you on the VRIC channel with John Fennick. You guys gave some great insights into the gold and silver mining space, so I really wanted to have you on the show. John's going to be coming on again later this month. But I want to start off with the broad question and stick to the metals themselves, putting aside the fact that physical precious metals are money. They're not really an investment that you make in hopes that they will go up. Which do you think presents the better value proposition at present for stackers, silver bullion or gold bullion?
Yeah, that's a good question. So I think that silver is probably you get at least 2x, maybe even 3x on your money as far as stacking. And the reason why, and not everybody agrees with this, but the reason why is because I think that the GSR will squeeze down to, I think it's going to go below 39, which it hit in 2012. So I think it'll go down to the low 30s. And so if it went from 90 all the way down to 30, I mean, that's more than, more than 100%. It's like
And
100%.
could you clarify what the GSR is?
The gold silver ratio.
Right.
So it's currently around 90. So if you cut it in half, so 2-to-1 leverage would be 45. And then, so I think it's going to be at least, you're getting more than, 2x your money leverage buying physical silver than buying physical gold. So I've always stacked physical silver and not gold for that reason, because I just think you're getting better leverage on your money. But that GSR might not hold. It could turn around and go back the other direction. So if you're a long-term thinking long-term hold, you might prefer gold, just because gold is a lot. It's Gold's considered money. Silver isn't necessarily considered money. So gold is kind of a better quality asset. So if you want the quality, instead of the leverage, you might go with gold. Plus, I think that gold could go a lot higher than we anticipate. So I think that silver is going to go up to at least $100 and probably 150. So if we look at, 150, we're at, 20, let's say we're at 25 today. We're like 23 something. If we just use 25, it's like, what is that? 6x. That's a lot of money, to get 150. You got a lot of leverage there. Now, but on gold, you're at 2,000. I think it could go to 8. And so that's like 3x your money, a little bit better than that. And so, silver, even if gold really explodes, I don't think it's going to get to 8,000, but I think 4 to 5,000 is kind of in the ballpark. But 4,000 is only 1x your money versus 6x. And then if it goes, to 6,000, you're 2x your money. So, you can see where silver to me, it just has so much more potential leverage. I'd rather stack silver than gold. And that's what I do stack. Also, I'm actually in the camp that because of crypto, because of Bitcoin, and because of kind of the younger generation adopting crypto, we don't know what crypto is going to do. And if crypto survives, if Bitcoin survives, is that going to be the new store of value for the next generation? And do they do away with gold and say, I don't want this stinking bar of metal. I'd rather have a digital money. Do we go towards a digital future? And if that happens, then gold could lose its value. And so I actually think that there's going to be a potential war between gold and Bitcoin once Bitcoin gets to about 100,000. If it gets to about 100,000, then there's going to be this tug of war between gold and Bitcoin of what is the popular store of value. And that's not a war gold really wants to have. It could lose that war. And so gold could become potentially irrelevant towards the end of this decade. But silver will never become irrelevant because silver has all these usages, in electronics, in medical devices, in automobiles. So silver actually has a much better use case, if you will, for long-term survival, I think, than gold. So I like silver. You have number one, you have the leverage, and then number two, I think it has better long-term survivability versus gold, which is kind of an odd thing. But even with crypto, I don't think crypto touches silver's value. This is what gets really odd, is that some people believe that silver will become more valuable than gold, which a 1-to-1 GSR. So when I add up all the data points, I'm like, I'm going to own silver.
Very interesting, especially what you mentioned about Bitcoin potentially competing with gold as the preferred store of value. I hold both Bitcoin and gold, and I have some guests on this show that feel the same way. But you're one of the first gold and silver experts that I've had on the show to actually kind of lay it out like that and say that that could be a possibility. So that's a very interesting scenario to also consider. I'd like to now move on to the mining stocks. And obviously, there's a lot more choice when it comes to gold miners as opposed to silver, because so much silver is mined as a byproduct of other metals. So there's not nearly as many pure play silver miners out there. But if you were looking at, let's say, a pure play silver mining company as opposed to gold, which on a broad scale do you think presents the better value right now? Is it silver as well because of the potential for the price to go up at a much higher rate than gold?
Oh, absolutely, because of the leverage you're getting. I think that silver is getting ready to run here for this year from 30 to 50. And once it gets above $30, I think it's going to be off to the races. Once you get to $30 silver, the margins will be about 30%. And until you get to 30%, the sentiment's basically going to remain very low in these. But once you get to a 30% margin, then it's going to bring in a lot of investors. And then every dollar above 30, the margins are going to keep blowing out and getting bigger and bigger and bigger. Margins right now in gold miners are much better than silver miners. But once you get to about $35 silver, they're going to start leaning towards silver. The silver miners are actually going to have higher margins. For instance, once you get to $50 silver, for instance, if your all-in cost is 25, your margins are pretty massive. 25, it's it's a 50% margin. It's a 100% margin. So 50, I think it's even better than that. If you go from $25 break-even cost and $50 silver, 25 and 25. I don't know. I have a cold. My head's not working. I don't know if it's a 50% margin or it's a 100% margin. I don't think you have 100% margin, so I think it's a 50% margin. But they can get really, really big in the silver miners versus gold, because gold's not going to make that kind of run. You're not going to have gold run from 2,000 to 4,000, for instance. You're not going to have those kind of margins in gold. So silver has more potential with margins, higher margins, which I think will push up the valuations of the silver miners. So for me, I've been talking about this group of 7 stocks that I've been calling the Mormons because you want to marry all of them. You want to have 7 wives. So you have Pan American, Hecla, Coeur, First Majestic, Endeavor, Fortuna, and I think Fresnillo is the other one. So you want to have these quality producers that the institutions are going to buy. The basically the brand names. So I call those the Mormons. You want to basically own all of them and make sure. And it's been a great opportunity time to buy them because they're all cheap. I mean, they're all basically 5 baggers or better, which is crazy because they've gotten really cheap because the margins are so terrible. I mean, Silvercrest is really the only one that has really good margins of of those 7 stocks, but their margins will improve dramatically as the price of silver goes up. So you want to buy those to the bottom right now. Endeavor like traded yesterday at $1.82, which is just ridiculous. I bought it in 2016 at $1.80, and it's come all the way back. So that one is one of the ones that is just still bouncing the bottom. So you just want to, you buy it at $1.82, and just if it goes lower, but buy it at $1.70, $1.60, $1.50, just buy it to the bottom. Some of these others have bounced off their bottoms. I don't know if they'll go back down. Coors trading about 210, 220. It bounced all the way to 350. Now it's back down. I think I'm not sure where it closed today, but I think it's under 350. So maybe it'll go back to 250, maybe. Hecla, if you can get that under $4, but Pan American, I think, is down to 15. If you can get it under 14. So a lot of these Mormons, you want to buy them as cheap as you can get to get ready to, hold those for the run that's coming. You want to own those from the move from 30 to 50 silver. And the reason why it's going to go from 30 to 50 is because of technicals. Silver hasn't been above $30 since 2012. So when it gets above 30, it's like blue sky. It's going to be really hard to stop it. Be like a train. You won't be able to stop it, I don't think. That's why I think it'll go from 30 to 50 within 6 months. So it's going to be a really nice run, and those 7 stocks are all going to participate.
I'd like to get some insight into how you evaluate gold and silver mining companies. And maybe starting with the scenario that a new gold mining stock crosses your desk. Let's focus on gold first. What are the main factors you're looking for and potential red flags that might turn you away?
So you actually have 4 different types of miners, and they all get analyzed separately, differently. And I wrote a book about how to do this. When I started doing this, 2004, and investing in juniors, there was no books available. So I learned it on my own, and then I published my own book. It's on Amazon. Has a lot of 5-star reviews, like over 100. So this is something, I've tried to do this before, but it's so technical. I mean, it can get really boring if I go, but I'll start. You slow me down. It's really because so if we start with let's say developers, I look for certain like 5 boxes. They have to check all 5 boxes, or else I basically, it's a no-go for me. So the first one is value. Since they have high risk, I don't want to touch anything that isn't a potential 10-bagger. Let's say $3,000 gold. It's got to have big upside. It's got to be cheap. That's number one. Number 2 is the location. There's certain locations that for me are non-starters. I'm just not going there. Like I don't do South. I've had bad luck in South Africa. I don't do South Africa anymore. Philippines, bad luck there. Indonesia, bad luck. So there's certain places that I just avoid, but I'll take more. I probably take more risk than a lot of investors. In my book, I talk about it, but there are certain locations that I will avoid. So locations is definitely, a big issue there. Next one is the management team, and the management team, they need to basically have the ability to build a mine. done it before. Um, I I might make an exception here if they haven't done it before. If the CEO hasn't done it before, but he has a good team around him, I might make an exception. But the stronger the management team, the better. That can add some risk. I find that a lot of these, and some of this, the management team, if I feel the management team is weak, I might not invest as much. If it's they're very green behind the ears, they haven't done this before, very young, I might not be as bullish about that. The next one is guidance. And guidance to me is all of these are deal breakers. They all basically need to be pretty solid, if you will. So guidance, this is probably the one where they miss the most. But yesterday somebody on Twitter, I'm on Twitter, and he sent me a company. So I did a list of 10 baggers, and it had I think 100 and over 100 names on it. And there's so many cheap stocks right now at $3,000 gold. And he gave me a list of this one company. I don't know if it was on the list or if it wasn't or what I like it, but I told him, I said, I don't own this stock. And the reason why is because they're not giving us strong guidance. And I think it was Baru, but I'm not positive. Might have been Bezra. Baru is one of those two, but I went and looked at it. They have enough gold. That's not the issue. The PEA is strong. It's okay there. But the company is not giving us guidance on exactly what they're going to do, how they're going to take it into production. And this, to me, is kind of part of the guidance and management are somewhat related here. And for me, I want a company that's passionate about taking it to production. So management has to be out there marketing it, telling us, and this is our plan. I love a company that has a plan and they're telling us what they're going to do. Silver Tiger and US Gold are two really good examples of companies that are basically building projects. They're telling you exactly what they're going to do. This is what we're going to do, A, B, C, D. And they'll answer questions on all each letter, A, B, C, D. Every step they'll answer questions. And so you get a good feeling that not only do they have the guidance that, okay, this is how we're going to do it, but they have the passion behind it. In other words, this is what we're doing. It's fait accompli. I want that fait accompli feeling. It's like, this is what we're going to do. It's going to happen. And then the final checkbox is insiders. I want them to have enough insiders that they can pull the plan off. So some company calls them on the phone and says, yeah, we like your project. We want to buy it. We'll give you 100% premium. Now, that's a pretty good offer, but we're going to build it ourselves. So you have a good day. That's what I want. So I want them to basically say no. They have vision. They want the profit. They don't want to give it away. They want it for themselves. And so those are the 5 check boxes that I look for. Now, in addition to all that, in my book, there are a ton of additional data points that you look at. So now we just go and we look at that top box, that valuation box. And that valuation box, it also has, part of that valuation is the project and the property. Being, how many ounces do they have? What's the grade? What's the CapEx? What's the NAV? What's going to be the what's the ASIC? What's the IRR? What's the recovery rate? You have all these little data points that you have to look at that are part of that valuation that gives you confidence that cheap valuation actually holds water. Okay, it's a 10 bagger, but is it a good project? Is the project there? And then another one that I didn't really talk about in my checkbox is that, how long is it going to take them to build this thing? The guidance is one thing, but are they going to be able to do it in 3 years? Is it going to take 5? Is it going to take 7? I like a construction decision within 3 years. but I'll go longer. I have no problem going longer. It's a long-term investment. I'm not a kind of guy that says that one's too far. I'm not gonna do it if I really like it. But again, it gets into the weeds. So there are a lot of decisions you have to make as an investor. You know, at what grade, what's enough? What recovery rate's enough? What NPV is enough? So you're going to compare the NPV to the CapEx. How close does it have to be before, it's okay? I saw today a news release where somebody had a CapEx higher than the NPV. Well, that's a non-starter for me. I'm not going to buy that stock. You want the CapEx to be about a half the NPV. You can go higher if it's a starting mine and then they're going to grow this thing. There's so many factors. It takes, you have to be doing this for at least 2 years to even get any close an inkling to how the little details that come into play when you analyze these companies. And right now we're just talking about development, so we can't really do exploration and producers. It's too detail oriented, if you will, and people get bored to death.
Well, I don't know if viewers here would be getting bored to death. You've already given some amazing information just in that little snippet. What is the name of your book for people who want to look for that?
How to invest in gold and silver, a focus on mining stocks. With a focus
Great.
on mining stocks, yeah. Yeah, all
Yeah.
you have to do is just go to Amazon and type my name in and look for the gold book.
Great. I'll actually put a link to it in the description below so people can check that out if they'd like. You mentioned PEA, preliminary economic assessment there. How do you look at economic assessments? Do you require them before you consider investing in a project? And obviously the confidence levels goes up when you go to a pre-feasibility and a feasibility study, but none of these documents are necessarily set in stone. So how do you look at economic assessments when evaluating a company?
PEAs is the starting point for a development company. So I wouldn't even consider investing in a development company without PEA. That would be needed. And I really want to know, where's the guidance for the PFS? When's the PFS coming? I've probably done a this is one of my weaknesses as an investor because I own a lot of positions. I probably have bought way too many development stories only on PEAs. And that's really not smart. You should really wait for the PFS because once you have the PFS, you have a better feel for the cost, you have a better feel for guidance, where they're heading. I've seen companies with PEAs just linger and linger and linger, and the project never gets built. And so the one thing that the PEA is going to give you is the difference between the NAV and the CapEx, which is a really important data point. So PEAs are important. It's basically a starting point for valuation. It's kind of a starting point for getting a feel for, is this mine ever going to get built or when it's going to get built? I always like to see them like Tudor Gold. They've been drilling forever and they've never done a PEA. And it frustrates me to no end because people have told me that, this mine is basically going to be too costly to build and mine. It's just not going to be economic because of refractory ore. And I'm going, and I don't own it because I'm just been waiting for the PEA. Give me a PEA. Give me an idea, of what your costs are going to be. And they won't do it. It's really their CEO. He's very slick. He's like, oh, we're going to do that next year. Yeah, go to their website right now and look for guidance that it's coming out in 2024. Even though he told me they're going to do it next year, and it's not going to be very difficult to do, and it's not going to be expensive. But okay, where's the guidance for the PEA? I always want to see a PEA as a starting point for a project, both as an exploration and a development. It doesn't really apply to producers. I want to see it. I want to get a feel for once you have a PEA, you can basically value a company. And without it, you're blind.
So When evaluating silver miners, let's stick to developers here. Is there anything different about your process? Are you looking at whether they're producing silver as the main metal or as a byproduct of another metal? Is there anything significantly different about silver deposits that people who evaluate these companies need to keep in mind, or anything else that differs from the way you look at a gold company?
By and large, yeah, there's a significant difference because generally with gold miners, the offset metals are not as significant, if you will, because you don't see a lot of low grade unless they're copper, unless they're gold copper projects. But if it is a gold mine, if you will, generally the gold is economic on its own. If it's an open pit, it's 0.8 grams or higher. If it's underground, it's 5 grams or higher. You don't see a lot of companies really, unless, again, it's a gold copper mine, but you don't see a lot of underground gold mines that are not at least 5 grams, or if there's maybe 3.5, 4. But most of them are economic on their own. So it doesn't really become a big factor, if you will. What becomes the factor is your cash cost. Is the cash cost low enough that they have a good enough margin where it's interesting? You don't want a high cash cost mine. So as long as the cash costs are about $1,000 or less, you're like, and it's a long life mine, and then it basically pencils out to a 5+ bagger. Then I might be interested. Now silver mines, they're a whole different animal because most of your silver mines, they actually mine them in silver equivalent. They're not silver mines, they're silver equivalent mines. And the silver equivalent is combination of silver, gold, zinc, lead, and sometimes a couple others. Those are usually the main ones. And those base metals are required. If they go down in value, they're generally not going to go up in value. So this is the real big takeaway here, is that when you have a low grade silver mine, let's say it's 60 grams per ton silver, but it's 150 grams per ton AGEQ. Well, the only metal that's really going to explode in value is silver, but you're not going to get the leverage that you're going to get over another company that's high grade silver because the other minerals aren't going to go up in value. So your costs really aren't going to come down that much. Your revenue is not going to go up that much because all these base metals don't go up that much. So you have to think in terms of, oh, silver's going up, my revenue must be going up, my free cash flow is going up. But if it's a low grade silver, it's not happening. So you got to be really careful on these low grade silver mines because you just don't have the leverage that you're going to have on the higher one. So I like to have at least 120 grams, at least 120 grams of silver, and then 150, 180. Once you get to about 180, which is 6 ounces per ton, you're generally pretty good. As far as leverage in silver, you don't have to really worry about, you're not really low grade. So about 150, 180, and I'm pretty comfortable. I'm like, that's a silver mine. Once you get below 90, 90 below, 90 is like kind of a cutoff. It's not Happy Valley for me, but 90, 120 is like, that's like that's like okay city, kind of thing. And then 150 above is, excellent city. And then, yeah, below 90 and you're in Death Valley kind of thing. It's like, oh, that's not good. They're making money, but they don't have the leverage that we want because when silver breaks out, we want this stock to break out too. And investors are going, well, hey, their free cash flow is not going up high enough, Don. I'm not buying it. So your share prices aren't going up. So you got to pay attention. A lot of these silver mines are actually silver equivalent mines, and they're not super leveraged versus like Silvercrest. I mean, it's basically an all silver gold mine, which is beautiful. It's like 100% leveraged. Silver price goes up, it goes up. I love that. It's one of the few. I is another one. I is basically silver gold. First Majestic silver gold. So when you got that mainly silver gold, you don't have a lot of lead and zinc. It gives you a lot more leverage. I mean, it's nice. I would prefer to have like only 20% base metals or less. That's kind of my sweet spot. I don't really want to go 50-50. Like, but I will do it sometimes. Like I own Santa Cruz Metals. They're like 30% silver, but I think they're going to get to 40. But they're producing like 14 million ounces a year of silver equivalent. So when you're producing that much and you're that cheap, they have a problem with debt, huge problem with debt. So I'm gambling as a spec bet. I'm just giving an example of a low grade silver miner. If they can get that debt paid off next year and survive, silver prices go to like, so as long as the silver prices go to $35 next year, I think they'll be okay. If they can survive next year and kind of fix their balance sheet, and then silver prices explode higher, silver prices get to $50, I think their silver production should be about 40% of their revenue. At that point, it should have some really pretty strong leverage from $50 silver up to $100 silver. And if their valuation, it kind of works. So some of these low grade mines, and the reason why it works is because they have so much of it, right? 14 million ounces. So it's low grade, but they have so much, and they make up for it in volume. Versus if they were only mining 3 million ounces a year, and it was 40-60, then it probably doesn't work that well. So you have to be careful on these small miners. They're very risky. A small miner that's silver equivalent, that's low grade, is a very dangerous investment. So you got to be careful on that because they just don't generate a lot of free cash flow. And then silver prices go up and they just don't have the leverage. They don't work. They don't, explode higher. But sometimes the volume can make it up. Like Silver X they have a lot of, it's a small silver miner and they have a lot of lead and zinc, but they have a lot of silver equivalent. They're kind of like Santa Cruz. They're not as big, but they can grow production and grow volume, and volume can make it up. So if it's a small miner and they have a lot of silver equivalent in the ground and they can grow production, I don't mind those plays because as long as it has that volume, it can work. It's the small miners that can't grow production that I don't like, unless it's a company like Impact Silver. It's pretty much a pure silver miner. I mean, they can mine 1 million ounces a year and make money because it's pure. And when you're pure, that's where your leverage is. And so, but they just bought a zinc mine, I think. So I don't like it when these companies go away from their niche, but they just did. They bought it's like 13% zinc. But it can generate a little bit additional free cash flow for them to help their balance sheet. I'm just hoping they can get to 2 million ounces of pure silver production. But so I don't necessarily dislike small silver miners, but I'm very picky. I'll basically ignore a lot of them and say that's a small miner. Impact's one of the few. Impact, Silver X, and Guanajuato. Those three I've kind of okay. I'll risk those small ones.
And when it comes to royalty and streaming companies, how do you view those? Obviously, much less upside potential. Generally speaking, much less risk. We saw Franco-Nevada crater a bit recently due to their 17% exposure to the Cobre Panama mine, which is facing all sorts of issues. How do you view the royalty and streaming companies?
Well, they don't fit my strategy. My strategy is to go after big alpha. I want a company that's at least 300% and ideally 500% to 1,000. I'm actually chasing 10 baggers. I mean, that's kind of my goal. I have like 164 positions and I'm hoping to find like 20 10 baggers out of that. And so if I'm chasing 10 baggers, I'm not really going to be chasing royalty plays. I think royalty plays work really well if you're a conservative investor, you're after dividends and you're after security. You basically, if you like Newmont, like Barrick and Agnico Eagle, then you're probably going to like Franco-Nevada and Sandstorm and Silver Wheaton. I think the majors and the big royalty plays are similar stocks as far as risk reward goes. And so I think they fit there. They fit in that niche. I use three gold mutual funds for my major exposure because I like about mutual funds is they actually pay out your capital gains annually. So those three mutual funds, I'm doing it for dividends, I'm doing it for income. I'm getting paid yearly. Whenever they do good, I do good. And so you get really big returns. And so I prefer mutual funds to chasing dividends on majors. Because again, the mutual funds actually pay out in the US for a US investor, they pay out capital gains annually. And so that's the way that I do that. And so instead of buying a royalty play or buy a major, I just stick with my three mutual funds.
And do these mutual funds hold a basket of minors? Or are they mostly the majors?
Yes.
How are they composed? Okay.
Yeah, they're mostly the majors. Mutual funds can't really buy juniors because there's not enough liquidity. So they stick with large mid-tiers and majors. Now they'll hold 30 to 40 stocks, 30 to 45 stocks. And they're basically, most of them are dividend paying. Vast majority are dividend paying. So they're basically going after the quality companies. I mean, I could just do one mutual fund. I mean, there's no reason why. They're all basically very similar. But the reason why I do three is for diversity. And I don't want to put all my eggs in one basket and have high. Basically, what I did was but my very first mutual fund, I invested in it for 10 years and got to 5,000 shares. Once I got to 5,000 shares, I'm like, and that was about $65,000. After that, I was like, I don't want to put any more money in that. So I went to another one, I put 5,000 shares, went to another, and they're all about $50,000. Another one, 5,000 shares. So it was all about diversity for me.
Well, Don, this has been an incredible conversation. You've provided so many useful bits of information, glimpses into your process. For those who want to learn more about your process and dive deeper, tell us about goldstockdata.com and what it is you do there.
Well, it's a fantastic website for anybody that owns a gold or silver mining stock. It's not really for newbies. If you don't own any, I don't really recommend it. But once you own one, or once you start doing gold and silver mining stocks, then it makes a lot of sense. The database has about 850. It has basically all the gold and silver miners in the world that have a market cap over 10 million. I'd say that maybe there's only 10 stocks that are missing, and they're missing because I don't cover the Hong Kong. I don't cover that one, and I don't cover Germany. So those two exchanges, probably maybe there might be 10 stocks I'm missing, but I cover the rest of the world. So the database is very comprehensive. The search engine is very comprehensive. I mean, you can search by just about anything. And then in tandem with that, for every stock that's in my database, I actually do a 2, 3, 4 paragraph analysis of the company. And then I grade them. I have 3 grading systems. You get data, you get my analysis, and then you get the grading. And then you can search by the grading. It's like, okay, show me, Don, every stock that you have rated with a B high or B plus, A, or every stock you have with a 4 or higher. I mean, there's so many ways to do searches. So the database is it's definitely worth, if you're looking, say, I want to go find a development stock. Let's go see what Don likes. I mean, let's go. And then I have all these links. You can do all your research. Plus, it has a forum with a bunch of smart people in it. You can ask questions. Plus, you get a newsletter. So it's a good value. I created it as an investor for investors.
Great. Well, I'll put a link in the description below to goldstockdata.com, as well as your book if people want to check that out as well. Thanks once again, Don, for coming on and sharing your knowledge with the audience.
Sure, Jesse. Thanks for having me on.
And thank you for joining us today. As a reminder, this episode is sponsored by moneymetals.com. Use coupon code JesseDay to get $10 off your first purchase. Link is in the description below, and I'll see you guys on the next episode. Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.